All assets that are not current are by definition non-current. They are also called long-term or long-lived assets. And here are the types of non-current assets. On this slide, we very briefly look at property, plant and equipment, investment property and intangible assets. Property, plant and equipment are obviously tangible. It is expected that this asset will provide an economic benefit over more than one fiscal period. In terms of valuation or in terms of measurement basis, IFRS says that we can use the cost model or revaluation model. The cost model is straightforward. We report property, plant and equipment at historical cost less depreciation. That's the cost model. And this number, the historical cost less depreciation, is also called amortized cost. Land is not depreciated. Note that the choice between cost model and revaluation model is only provided by IFRS. US GAAP says that we are only allowed to use the cost model. Investment property, this is property that is not used in the regular operations of a company. So if you have a given company that has purchased property in another location and that property has nothing to do with the core operation, then that property has to be marked as investment property, and there are accounting rules and valuation rules for an investment property, which we will study later. This concept of investment property is only in IFRS. US GAAP does not mention this term. Intangible assets are identifiable non-monetary assets without physical substance. Classic examples of intangible assets would be copyrights and patents. According to IFRS, we report intangible assets using the cost model or revaluation model. US GAAP allows only the cost model. These items will be covered in detail later when we do the reading on long-lived assets. Goodwill is another item that you might see on the assets side of a balance sheet. Goodwill arises when one company is purchased by another company. So note this point, you can only have goodwill when there is a purchase. If the purchase price is greater than the fair value at acquisition, then goodwill is created in the acquirer's balance sheet. Once you have reported goodwill, it is subject to impairment. And impairment is a concept that we'll discuss later, but very simplistically, impairment is a mechanism for reducing the value of an asset. Let us understand how goodwill is created. Let's say you have company A, which buys company T, and this purchase takes place for 100 million. The book value of company T's assets and liabilities are 125 million and 75 million, which means that the net book value or equity is 50 million. However, the fair value of company T's assets and liabilities are 160 and 75 million. As we've discussed before, there might be some items on the balance sheet which are not reported at fair value, which is why there is typically going to be a difference between fair value and book value, and we note that over here. The fair value of assets is 160. The fair value of liabilities happens to be the same as the book value of liabilities. So the net fair value is equal to 160 minus 75, which is 85. When company A purchases company T, what really matters is the fair values and not the book values. Note that company A has paid 100, which is more than the fair value of the net assets. The additional amount that the company paid, that additional amount of 15 million, which was paid above the fair value of the net assets is goodwill. And as the term implies, this extra amount is paid because of the goodwill that company T has generated. Now, company T might have lots of satisfied customers, they might have a very good brand, which is why the value for the overall company is more than simply the net assets that it has.
We now come to financial assets. A financial asset for a particular company is the financial liability or equity instrument of another entity. So what does this mean? Let's say we are looking at the balance sheet of a company and say that company is Microsoft. Let's also say that we have another company, General Electric, and General Electric issues a bond. For General Electric, this bond is a liability because through this bond, General Electric is raising money. But Microsoft buys this bond. For Microsoft, this bond is an investment. It is a financial asset. So on Microsoft's balance sheet, this bond, the General Electric bond, will appear as a financial asset. Now let's also say that Microsoft buys General Electric shares. Those shares are equity for General Electric, but for Microsoft, those General Electric shares will also be classified as financial assets. So that's what we mean when we say that a financial asset for a given company, such as Microsoft in this case, is the financial liability or an equity instrument of another entity. In my example, the other entity is General Electric. Now that we've established what we mean by a financial asset, the next question is, how do we measure financial assets? There are two broad ways of measuring financial assets. One is based on fair value and the other is amortized cost. The fair value of an asset is simply the arm's length transaction price. So let's talk about the bond that Microsoft bought. This is a GE bond, and let's say that the market price of this bond is $90. Now this is the market price, this is the price at which the bond is trading. So we can say that the fair value is $90. This is the arm's length transaction at which any party can buy the bond. So that is one way of measuring financial assets. The other way is amortized cost. The amortized cost of a financial asset is the historical cost or the original cost plus or minus any amortization. The concept of amortizing a bond will be discussed later in the reading on long-term liabilities, but I'll give you a very simple idea right now. Let's say that Microsoft buys a 5-year bond and the 5-year bond has a par value of 100. This bond might have a value of 90 when Microsoft buys it, but over time this amortized amount will increase to 100. How this increase happens we'll discuss later, but the value shown on the balance sheet is the historical cost and then the amortization adjustment, which happens every period. So this amount that is shown on the balance sheet is the amortized cost. So when do we use amortized cost and when do we use fair value? If Microsoft plans to hold the bond till maturity, then it uses amortized cost. The reason is the fair value or the market price doesn't really matter here because the bond will be held to maturity. Ultimately, Microsoft will get the par value. So if the market price fluctuates up and down, that does not make any difference to Microsoft. Therefore, holding such a bond at amortized cost makes more sense. This category is also referred to as held to maturity, and that makes sense given the fact that the company intends to hold that instrument till maturity. If a company does not intend to hold the financial asset till maturity, then the financial asset should be measured based on fair value. And with fair value, there are again two options. Obviously on the balance sheet we will show the fair value, but the question is, if there are changes in fair value, then how are those changes recognized? One way of recognizing the change in fair value is through the income statement. So if the original fair value is 90 and then a month later the fair value goes up to 95, this unrealized gain of 5 shows up in the income statement. The other way of recognizing changes in fair value is through other comprehensive income. Here, the unrealized gain bypasses the income statement and is shown in other comprehensive income, which is part of equity. So here, essentially, the unrealized gain is bypassing the income statement. Now, the question is, when do we recognize unrealized gains through the income statement, and when do we recognize unrealized gains in OCI? If a financial asset is bought with the intent to trade, then unrealized gains are recognized through the income statement, and such instruments are called held for trading. On the other hand, if there is no immediate trading intent, then sometimes this sort of an asset is referred to as available for sale. The term available for sale is used in the US GAAP context. IFRS used to have this term, but now this term has been replaced by a long-winded term, which is financial assets measured at fair value through other comprehensive income. So again, the term AFS, while used in general, strictly speaking in the IFRS manual, this term has been replaced by another term, and I'll repeat that for you so you can remember it. So that term is financial asset measured at fair value through other comprehensive income. It's essentially a description of what we are doing. Before moving on, there are two more points I want you to remember. The first is that realized gains are shown on the income statement for all categories, and this is a popular exam question. So if you are told that a financial asset is initially worth 90 and then before the end of the period this asset is sold for 95, since the asset is sold, the gain of 5 is realized, and this realized gain will show up on the income statement regardless of how the financial asset is categorized. The second point has to do with mark to market. This term shows up quite often. Mark to market is the process whereby the value of a financial instrument is adjusted to reflect current value based on market prices. So this term applies when we are referring to financial assets which are measured at fair value. If the fair value was initially 90, then the fair value goes up to 92 at the end of the period, but the company still holds on to this financial asset. On the company's balance sheet, the value now needs to show up as 92. So the process of increasing the value from 90 to 92 is called mark to market. And you can learn this term by remembering that we are changing the price on the balance sheet or the value on the balance sheet based on market price. So we are essentially connecting the balance sheet with the market price. That's why this is called mark to market. Now let's work through an example which will go over the different ways of measuring financial assets.
This example will help clarify the concepts we are talking about. Let's say company owners contribute 100,000, which is invested in a 20-year bond with a 5% coupon paid semi-annually. After 6 months, the company receives the first coupon payment of 2,500. At this stage, the market price has increased to 102,000. Show the balance sheet and income statement treatment under each of the following categorizations. Now, note that on the balance sheet, initially, let's say we are the owners, so we make a contribution of 100,000, and that 100,000 is immediately invested in a bond. This question is asking us about what we report at the end of the 6-month period on the balance sheet and what we report on the income statement related to this 6-month period.
Let's take the fair value through profit and loss scenario.
The cash at the end of 6 months is going to be 2,500. This is the cash that we receive from the coupon payment. So the cash is going to be 2,500. On the balance sheet, we show the cost of the security, which is 100,000, plus the unrealized gain or loss. In this case, the security went from 100,000 to 102,000. So we have an unrealized gain of 2,000. Note that effectively we are showing 102,000 on the balance sheet, and this connects with what we just talked about, that the current fair value of the asset needs to be shown on the balance sheet. Before we come to the equity segment of the balance sheet, let's just look at what's happening on the income statement. The interest income of 2,500 is going to be shown. This is a realized income because we've actually received the money. The unrealized gain is also going to be shown on the income statement because this is held for trading. So the unrealized gain is 2,000. This entire amount reflects our net income. Let's say that this entire net income is retained. So this comes to our balance sheet as retained earnings. The paid in capital, which is that initial contribution, is 100,000. And in this particular case, held for trading, there is no OCI. Notice that the balance sheet balances on the asset side, we have 104,500, and on the equity side, we also have 104,500. There are no liabilities. Now I want you to pause the video and come up with the numbers for AFS and held to maturity. Here is what you should come up with. With AFS, the cash again is 2,500 because that's the coupon payment that we are receiving. The cost of securities, 100,000, that's the original purchase amount. Remember that with AFS we said that the item is going to be shown at current market value. So the unrealized gain of 2,000 is shown on the balance sheet. We also said that with AFS, the unrealized gain is not shown on the income statement. So notice on the income statement, we only show the interest income. So this is only the interest income on the income statement. The unrealized gain of 2,000 is shown as OCI, and OCI is part of equity. So OCI goes up by 2,000. The retained earnings of 2,500 are coming from here, and the paid in capital is 100,000 as before. So here again the balance sheet balances, but notice the difference between fair value through profit and loss and AFS. The critical difference is that unrealized gain with held for trading is shown on the income statement, but with AFS, the unrealized gain is shown straight in the equity segment under other comprehensive income. This should also connect with the example that we studied at the end of the previous reading. With held to maturity, our treatment is the simplest because we completely ignore any unrealized gains. Cash goes up by 2,500 because that is the coupon that we actually receive. The cost of the security is shown 100,000. We do not show any unrealized gains. The paid in capital is 100,000 as before. The retained earnings of 2,500 come from the interest income that we generated, and we are assuming that all of that was retained. You need to understand this example very well. As I said before, I think this is highly testable. On this slide, we will summarize the three ways of measuring financial assets. One method is to measure financial assets at cost or amortized cost. The second method is to measure at fair value through other comprehensive income. And the third method is to measure at fair value through profit and loss. Let's talk about the first method. In the US GAAP context, this is also called held to maturity because this method is used for debt securities that are to be held to maturity. This method is used for loans and notes receivables. And under IFRS, in very limited circumstances, this method can be used for unquoted equity instruments. So the limited circumstances have to do with situations where the fair value is very difficult to estimate and the cost is a fair proxy or a reasonable estimate for fair value. Next, we have measured at fair value through OCI. In the US GAAP context, this is also called AFS or available for sale. Under IFRS, this method is used for debt securities where the business model involves collecting interest and principal payments and also possibly selling the security. In other words, we don't intend to hold the security to maturity. This method is also used for equity instruments for which the company irrevocably elects this measurement method at acquisition. So when buying a particular stock, the company elects that fair value through OCI will be used, and this option is only available in IFRS. Then we have measured at fair value through profit and loss. All equity instruments need to be measured this way under US GAAP. The exception here is equity instruments where the investor has significant influence. For this, a different method is used, but we discussed that method at level 2. Trading debt securities are also used using this method. Here you might hear the term held for trading. So if we buy debt securities with the intent of trading or selling, then this method is used. In the IFRS context, if a security is not categorized using one of these approaches, then we use this method. So in that case, the security is measured at fair value through profit and loss. When a security is purchased, a company can elect that it will use this method. So that's the final point over here, and this is only under IFRS. Non-current liabilities. All liabilities that are not classified as current are non-current. Under long-term financial liabilities, we can have loans, notes, bonds payables. We can also have deferred tax liabilities. These result from temporary timing difference between a company's income as reported for tax purposes and income as reported for financial statement purposes. In case your head is spinning, that's all right, because there is a full reading on this material later. That reading is called income taxes and long-term liabilities or non-current liabilities. This is also a reading that we will cover later.